deductions. And remember the substantial economic effect, that's in the 704-1 regulations that we spent a long time on, very lengthy regulations. And now 1.704-2 deals with a special type of allocation issue, these non-recourse deductions. Dash 2 is not as lengthy, but it's more jargon filled. That's what makes it hard. The jargon, you gotta get comfortable with it, just takes a while. And then we're gonna move to Dash 3, the Dash 3 regs, which deal with, remember, 704C property that has a book value different than its basis, generally because it was contributed property. So you can think about Dash 1 is just a general rule, and then we have some special rules for non-recourse deductions and for allocations with respect to contributed property, Dash 2 and Dash 3. So we left off last class, we're on this problem involving non-recourse deductions. It's on page 151. And I'll review we did A, but I'll go over that again because we're going to start to change some facts. So we'll review that, see where we are, and then go on to change the facts. So, and one key here is just if there's a problem that involves a non-recourse deduction, then that's your issue spot in terms of, these special issues come into play. So before, we've never had to deal with non-recourse deductions because none of the problems we've dealt with thus far involve non-recourse debt. So once you have non-recourse debt, then that should cause you to think about these Dash 2 regulations. So in A, we've got G and L. G contributes 80. L contributes 320. They take that they take that 400,000. And they borrow another 1.6 million on a non-recourse basis. And then you flag that and you say, okay, non-recourse debt. So we got to think about Dash 2. And they buy a building. It buys a building, partnership buys a building for $2 million. Depreciable $200,000 a year for 10 years. All operating income and operating expenses offset. So everything except for depreciation offsets. So we're left with zero net income other than depreciation, leaving the depreciation just to be allocated. In year one, we get 200,000 of depreciation. We have to allocate that. Now, so once you identify that there's non-recourse debt, now you have to keep track of the partnership minimum gain. So let's keep track of that. We'll create a minimum gain table down here or up here, make it up here. So the minimum gain, we're going to figure out the minimum gain at the end of each year. At the end of year 0, it's going to be 0. That's like before it even begins. So that's easy. Year 1, what's our minimum gain at the end of year 1? Well, let's turn to the regulation. So we're going to be in the 1.704-2 regulation. So we'll be flipping back and forth. So keep that open. So let's look at Dash 2D, 1.704-2D. Nice heading here. The amount of partnership minimum gain. That's really what we want to know. It tells us how we do it. The amount of partnership minimum gain is determined by first computing for each partnership non-recourse liability Any gain the partnership would realize if it disposed of the property subject to that liability for no consideration other than the full satisfaction of the liability. And then if you had more than one property with non-recourse debt, you would add them up together. We only have one property, one non-recourse debt. So we go back here and our minimum gain says, okay, what if we sold this building for the amount of non-recourse debt and not a penny more? We'd have an amount realized of 1.6 million. We'd have a adjusted basis of 1.8 million. We'd have a 200,000 loss, not a net gain. So minimum gain can't be negative. So if that calculation is negative, we just have zero minimum gain. And when you don't have a change in minimum gain from year to year, then there's no special rule applies. So we no longer have to, at least for year one, we don't have to worry about these -2 rules. They don't apply. So we're just back to the general rule, -1, substantial economic effect. So we allocate the depreciation. The partnership agreement says it's going to be allocated 20% to G and 80% to L until the point where they reach profitability on an overall basis, and then it'll flip to 50-50. Partnership's losing money here, losing 200,000 a year. Remember, everything else cancels out except for the depreciation. So we're still in that 20-80 allocation. So that means we're going to allocate 40 to depreciation to G and 160 to L. And we test that for substantial economic effect. And it has it. And the only interesting thing to note here would be that L is not obligated to restore deficits. So, but there is a QIO and the first two of the big three. And so we can say for L, there's no, this has economic effect because it doesn't drive L's capital account below 0. Takes it to 160, positive 160. Okay, any questions about year one? So G would report 40 of the depreciation, L would report 160 of the depreciation. Nothing on year one. I go to year two, and again, let's look at the minimum gain. So a minimum gain says, hypothesize a sale of the property securing the non-recourse debt. That's the building, for the amount of non-recourse debt and no more. Now we have 1.6 million of book value, 1.6 million of debt. Again, we have no minimum gain. We don't have a negative number. We have a 0, but it doesn't matter whether we have that calculation is 0 or negative. It's just 0 minimum gain. So again, we just apply the rules you've already learned. And that's going to be fine. Again, L is getting right at the precipice. L now gets capital account to 0, not negative. So L may have problems in future years, but not here. And both of these, the idea here is that this is eating through the equity layer. Remember, there's 400,000 of cash that they put in, and there's 1.6 million of debt. The first 400,000 of deductions, net loss, if you will, is going to be borne by G and L economically. It's going to eat through that equity slice, and that's what's happened. Once we get to year 3, now G and L are no longer bearing the burden, the economic burden of any reduction in the book value of the building. So again, we go to year 3, another 200,000 of depreciation. Well, now minimum gain, we have 1.6 million. We sell it for 1.6 million. Our amount realized is 1.6 million. Our book value is 1.4 million. 2 million less the 600,000 depreciation. So now we have 200,000 of minimum gain. And when you have an increase in minimum gain, that generally indicates the presence of non-recourse deductions. Let's look at the reg here, dash 2C. Let's look at dash 2C. It says the amount of non-recourse deductions for a partnership year equals the net increase in partnership minimum gain during the year. And then we reduce that by certain distributions that we'll talk about later on. But the general rule is the increase in minimum gain becomes non-recourse deductions. So now we know we have 200,000 of non-recourse deductions. Well, we have other deductions. Let's say we have maintenance deductions, and we have salary expense, and we have depreciation. We haven't really had to deal with the other expenses because those just canceled out. But now it may be, we can ask, well, what deductions are the non-recourse deductions? Which deductions are treated as non-recourse deductions? And we go down here and it says generally, this is going to be the case for our class. Non-recourse deductions consist first of certain depreciation or cost recovery deductions. So it's going to be depreciation on the building, on the property, which secures a non-recourse debt. So this takes this 200,000 is not going to be a non-recourse deduction. It's going to turn them into non-recourse deductions. So again, they're allocated under the agreement 40 and 160. And I put a little asterisk there just to indicate that those are our non-recourse deductions. Well, now we don't test non-recourse deductions for substantial economic effect. Non-recourse deductions can't have economic effect by definition. Let's go back to the reg. Let's go to dash 2B. Allocations of losses, deductions attributable to partnership non-recourse liabilities. A non-recourse deduction cannot have economic effect because the creditor alone bears the economic burden. They can't have economic effect. They can't have substantial economic effect. Thus, they have to be allocated in accordance with PIP. But we know PIP is that facts and circumstances test. If we were left to rely on that, there wouldn't be a whole lot of certainty. So then paragraph E provides a test that deems non-reallocation, that deems allocation non-recourse to be in accordance with PIP. And if that test is not satisfied, then we're back to the general PIPs test. So this is the dash 2E safe harbor. So we have substantial economic effect safe harbor for most types of allocations. And now we have this dash 2E safe harbor for non-recourse deductions. So let's apply the dash 2E safe harbor. Hopefully we satisfy it. So here are the 4 conditions for E. You have to be teed up for economic effect on the general test. So either all 3 of the big 3 are satisfied, or you have to have a qualified income offset. So you're teed up for general test or economic or alternate test, we have that. G, the general test is teed up. 4 applies for L. The alternate effect test applies because the first 2 of the big 3, and the partnership agreement has the QIO. Okay, and that's, again, looking at the agreement. You got to be teed up for the substantial economic effect safe harbor. 2, beginning in the first taxable year in which there are non-recourse deductions, that'll be year 3 here, and throughout the full term of the partnership agreement provides for allocations of non-recourse deductions in a manner that's reasonably consistent with allocations that have substantial economic effect of some other significant partnership item attributable to the property. So it asks, and it says, okay, you can specially allocate this non-recourse deductions. You can have some flexibility, but you have to be able to show that the way you allocate these is reasonably consistent with the way you allocate other items that are from the property, other tax items from the property. So if it's a building, things like rent, how do we allocate the rent? How do we allocate the maintenance expenses? Here, it's pretty easy. We're allocating everything 20/80. And so, see, and we actually are allocating the rent 20/80. It's just that the rent is being canceled by the maintenance expenses, which are being allocated 20/80. This seems to be pretty easily met. We're going to see a case where it's a little harder. What this means is if you allocate everything else 50/50, and then you allocate this 99/1, right? That's going to be a problem. So we're giving you flexibility here, but it has to be consistent with the way you're allocating something else. So we're not giving the taxpayers carte blanche to play the game they want to play, but we're saying if you want to play that game, you're going to have to allocate something else significant in that same way, or consistent with that. Does that make sense? And then 3 is pretty straightforward. We have to have this minimum gain chargeback provision, which we're going to talk about. We have that. That's in the agreement. So 1 and 3 can be evaluated just by looking at the agreement. These things are in the agreement or they're not. 2 requires some analysis of reasonable consistency. And then 4 is just that all other material allocations and capital account adjustments are respected. Gives the government flexibility if things are being allocated, reallocated under PIP, that, sort of all bets are off. And applying that here is we satisfy all those here. This is pretty easy. It's pretty straightforward. So these allocations are deemed to be in accordance with PIP under -2E. Whereas these up here were substantial economic effect. Okay. So that is our answer to A. Let's just run one more hypothetical here. Let's go to year 4. Let's say on January 1 of year 4, we sell the building. We sell the building for $2.1 million. Okay. So we sell the building for $2.1 million. We would have our book value is $1.4 million. We would have $700,000 of gain. We also, at the end of year 4, we'd have no minimum gain, because if we sold it for 2.1, we'd pay back the creditor. The debt would be gone. The building is gone. We have no minimum gain. So now when minimum gain goes down, that triggers the minimum gain chargeback provision. Let's look at -2F. In the regs, -2F. We have a minimum gain chargeback provision in the agreement, which we have to have if we're going to be in a -2E safe harbor. And it says if there's a net decrease in partnership minimum gain for a partnership taxable year, the minimum gain chargeback requirement applies. And each partner must be allocated items of partnership income and gain for that year equal to that partner's share of the net decrease in partnership minimum gain. So when your partnership minimum gain goes up, that indicates the presence of non-recourse deductions generally. When your minimum gain goes down, that triggers generally the minimum gain chargeback. And what happens in minimum gain chargeback is you're going to get allocated items of income and gain equal to the partner's share of the net decrease in minimum gain. So here, and what is a partner's share of minimum gain? It's generally the non-recourse deductions previously allocated to them that have not yet been charged back. So there's 200 of minimum gain in year 3, G has 40, L has 160, goes down 200. So we're going to charge back the first 200 of gain gets charged back 400 and 160. That's our minimum gain chargeback. And that happens regardless of whatever else, here it's pretty straightforward because we're allocating everything on the downside 2080. So you might say that's not that interesting. That's not, because this is how it worked generally. But again, we'll see a case where it's more complicated. So that's the first 200. Are allocated pursuant to minimum gain chargeback provision. The remaining 500 get allocated according to the partnership agreement, the general rules of partnership agreement, which says 2080 until they reach profitability. So here, there's 100,000 of true gain, of real gain, right? Because they start with 2 million, they're selling it for 2.1 million. So we have 100,000 is going to be allocated 50-50. Remember, we go 20-80 until we hit profitability, and then after that 50-50. So we have another 400 of gain that's going to be allocated 20-80. So that's going to be 80 and 320. Those allocations have substantial economic effect. They're increasing L's capital account, not decreasing it. And then the remaining 100 of gain is going to be allocated 50-50. So that's a total of 220 and 580 here. And G's capital account is going to be what's it going to be? It's going to be, I'm sorry, not 100. It's 100 to be allocated 50-50. So it's 50 and 50. So G's capital account is going to be 130. L's capital account is going to be 370. And so now the partnership has 500,000 of cash. Remember, it's got sells it for 2.1 million. Got to pay the creditor 1.6. There's 500,000 of cash. It's going to go 130 and 370 to L. But the point is here, the most important thing here is this not minimum gain chargeback. That's going to happen at some point. Here it was sold. If the property is abandoned under Tufts, you're going to get this amount. If the debt is reduced, the lender says, "Hey, we'll reduce the debt from 1.6 to 1.4. So it's going to happen here. It happened through a sale. When it happens, we're going to charge it back. And that, so again, we're going to make it reasonably consistent. We're going to make the way they share it, you know, close to the way they share other items that have economics. And then two, we're going to make sure that whatever amount G gets of non-recourse deductions, when the time comes, it'll get charged back. Basically what's going on here. Okay, so that's A. Any questions on that? Okay, let's jump down to C now. We'll do B in a second. So in C, the partnership agreement is specially allocating non-recourse deductions. So instead of allocating depreciation writ large separately, specially, it's just allocating the non-recourse deductions specially. So it doesn't change in year one and year two. We're still allocating the depreciation 2080. Here, the absence, the fact that this is not non-recourse deductions changes the way it's allocated. In problem A, we're going to allocate it 2080 regardless because it was depreciation. Here, we have to do this analysis to even know whether to go 2080 or 3070. So we get to year three, and now we have the minimum gain. Now we have non-recourse deductions, and because they're non-recourse deductions, the agreement is going to allocate them 30% to G, 70% to L. So the question here is this an allocation that is reasonably consistent with the way they're allocating other items that have economic effect? And you might look at it and say, well, no, they're allocating everything else 2080. It's going to go 2080. Now down the road, if it reaches profitability, it's going to flip, and we're going to allocate everything 50-50, other than non-recourse deductions. So you might say, well, this is not reasonably consistent. The regs are pretty generous here. So let's turn back to the regs. Dash 2M has an example that's useful here. Dash 2M, example 1. Has a similar flip arrangement where they're allocating except as otherwise required, they're going to be allocated 90-10 and then equally. So similar flip arrangement here. 90 to LP, 10 to GP, and then 50-50. So here, we're doing 2080, then the 50-50. They're doing 1090 and then the 50-50. And then if you go down to the analysis, here's a fact. There's a reasonable likelihood that it will get into that positive territory. That's together with our fact. That's the same fact in our problem. And I'm not, in most cases, most partnerships, you would expect to have a reasonable possibility you'll be profitable. But maybe if it was a long shot, maybe this rule we're going to see wouldn't apply if it's not sufficiently likely. But what this rule says down here It says the allocation of non-recourse deductions 75 to L and 25 to GP, or in any other ratio between the two thresholds would satisfy the reasonable consistency requirement. But to be clear, down here in 3 little i's, if it was 99% to 1, 99-1, that doesn't satisfy it. So what that means here is that any sharing ratio between 20 and 50 to G and 50 and 80 to L should work, because we're within that range. But if we went 81 to L and 19 to G, that wouldn't work, presumably. I don't know, maybe 79, I'm sorry, 81 and 19 is close enough. I mean, clearly 99 to L, 1 to G wouldn't work. But we can specially allocate it within that range and not fail the reasonable consistency requirement. And so again, under dash 2E, this works. We just haven't gone crazy, right? You don't go too wild with these non-recourse deductions, as long as you stay within the sort of general way you're allocating your other items, then you should be okay. Any questions on C? Now again, let's say the next year we abandon the property. We say, you know what, again, the book value is 1.4 million. It's already underwater. If it's real economic value is its book value or below, then I don't want to pay any interest on this loan that's underwater. So we just abandon it. So when you abandon it, and you can do that, you have your rights under the agreement, and you can abandon it and walk away, wipe your hands of it. So you do that, and you again have minimum gain of 0 afterwards because the debt is gone. Under the Tufts rule, you have 200,000 of Tufts gain, because when you dispose of property subject to a non-recourse debt, the amount realized includes the non-recourse debt. So our amount realized is 1.6 million. Our book value is 1.4 million. That's 200,000 of Tufts gain. That's minimum gain. That's what our minimum gain is, and our minimum gain chargeback. I'm sorry, it's not minimum gain. It's our minimum gain chargeback is going to apply to that, and it's going to charge it back, regardless of what the agreement says. Because generally, the agreement would say without the minimum gain chargeback, it would be 2080. But here, the minimum gain chargeback is in the agreement. It trumps everything else, and it says charge it back in the same ratio as their share of the non-recourse deductions. That's dash 2F. At that point, the partnership has nothing. Remember, it just handed over the property, its only property, to the lender. And so the capital accounts are appropriately 0. Any questions on that? All right. One thing people might think about is this right here. If we stop the music right here, L's capital account is -140. And you may think that's a problem. I mean, L has no LDRO, has no unlimited deficit restoration obligation. L doesn't have any limited one. G is -60, but we don't care so much for G. Not a problem, because G has an unlimited deficit restoration obligation. What about L? And remember, when a partner gets below 0 who doesn't have an LDRO, that's when we start to worry about things like QIO and stuff like that. But actually, this is not a problem. Let's go back to dash 2C C, I'm sorry, dash 2D in the regs. Actually, dash 2F. Where is this? Dash 2G. We haven't looked at G yet. G is calculating the partner's share of minimum gain. We've already talked about this, but it's equal to your generally sum of non-recourse deductions allocated to you, and which have not been charged back. This is what tells you to reduce your share of minimum gain once it's been charged back. You don't double count effectively. But the sentence I want to clue you into here is this sentence. It says that a partner's share of minimum gain is added to the LDRO. It's treated like an LDRO. So a partner's share of minimum gain is treated as an LDRO. It allows you to go below zero. And that makes sense because when you have a share of minimum gain, that means inevitably your capital account is going to go back up at some point. Most likely when you satisfy the minimum gain chargeback provision. So it's temporarily, like if we go back to this problem, you see it's inevitable that L's capital account, although it's negative, it's going to come back to positive. Think about this property. We just did with this property sort of the least profitable thing we could do. We just handed it to the lender. We could have blown it up. Could have done like the Trump Casino in Atlantic City. I mean, the lender wouldn't like that. We couldn't probably under the law do it. But if we did it, L still has gain. So it's only temporary, and the regs realize that and say, okay, it's not a problem. We're not gonna have to worry about L going below zero because it's just temporary. So the QIO isn't gonna be triggered, and we don't have to worry about that. Okay. Questions on C? Okay, let's do B. So B, I want to change the facts just slightly, but subtly here to start. Let's say it says 99% and 1% of all the partnership's non-recourse deductions. It just says cost recovery deductions. Let's change it for a second to non-recourse deductions. And if we do that, it doesn't change years 1 and year 2 because those are not non-recourse deductions. So we don't have to change that. But we go to year 3 under the agreement. Here we go 1% to G and 99% to L. And again, we test it under dash 2E, and this is going to fail. We actually have that reg example, dash 2M, example 1. I forget which subpart, paragraph, but it said that that was 1090 to 50/50. It said 199 is not going to work. It's not reasonably consistent. So this is going to get reallocated. So this is going to fail the dash 2E. It's going to get allocated under PIP. How does it get allocated under PIP? It's not entirely clear. Again, we're under this facts and circumstances test. Presumably it's going to get allocated under 2080 because that's the way everything else is being allocated on the downside, or 50/50 because that's the way everything else will be allocated once it reaches profitability. Perhaps it's a function of the likelihood of profitability being reached. If it's more likely than not that profitability will be reached, perhaps 50/50 is the right answer because that's where we're going. tax planner won't like this. It's just uncertain, right? You don't know what the IRS will think. You don't know what the judge is going to say. There's not a lot of guidance. There's no guidance really. And so could you give an opinion that this will or should be the result, the result that will or should be? I don't think so. Not a definitive one. You could say 20/80 or 50/50, one of those two. That's pretty definitive, I think. But to pick one or the other, I don't think is going to be easy, going to be able to do with a confident level, with a high degree of confidence. So it wouldn't work. All right, any questions on that permutation of B?
Yeah, I have a question. Would the first two years work? I know we changed the problem to say non-recourse deductions, but if taking the text as it's presented.
Okay, I'm going to go. So I was going to now go. I'm going to hold off on that thought. I'm going to go to the actual problem in a second. But any questions about this permutation? We'll move to the question in B as was asked in a second. Okay, well, let's do B how it was asked. So now all depreciation is allocated 99.1. So in year one, we would allocate 2 and 198. And we test that for substantial economic effect. Again, you don't have any increase in minimum gain in year one. So these are not non-recourse deductions. And the analysis really is going to be, okay, L, does this drive L's capital account below 0? And the answer is no. L's capital account is still positive at the end of year one. You go to year two, now we got a problem because L's capital account would be negative 76. So we look and we say, okay, does L have any LDRO to support? The answer here is no. L has no obligation under the agreement to kick in any more money. L has not contributed a promissory note. Under certain circumstances, we haven't really gone into this yet, but under certain circumstances, if you're liable for the partnership debts, you could get a deemed LDRO there, but as a limited partner, hasn't signed a guarantee of any sort to any lender. L just has no obligation to ever kick in any money to this partnership. So he has no LDRO, and so 76. Now again, 122 of the allocation is valid. It has economic effect. Remember, the alternate effect test says to the extent it does not drive your capital account below 0 or your LDRO amount, it's valid. To the excess, it's going to not have economic effect on the alternate test. So we have 76 of deductions that don't have economic effect. We can reallocate under PIP. And again, we can look at the special PIP rule. We say, what if the partnership had liquidated for book value at the end of year one? The partnership had liquidated for book value at the end of year one. We'd have 180 of proceeds. We pay off the debt. We'd have 200 of cash. How would it go? Well, it's going to go 78 to G, and 122 to L, right? Because that's G's capital account at the end of year one, and L's capital account at the end of year one. And we liquidate according to positive capital account balance. That's prong two. So end year one, that's how the cash would go. End year two, we liquidate for book value at the end of year two. We sell the property for 160. We pay off the creditor sorry, not 160, 1.6. We pay off the creditor. We got nothing left. So we have no distributions to anybody. G is going to get 0, and L is going to get 0. Nobody has any obligation to kick in any money. Nobody has a promissory note. And so this special PIP rule says we compare the results. L is going from 122 to 0. Well, that reflects the 122 that's allowed to him. That has alternate economic effect. So we know what he gets 122. G goes from 78 to 0. Now he gets 2 under the agreement. The missing 76 is that allocation that gets shifted from L to G. So at the end of the day, L is going to get 122 of the depreciation, and G is going to get 78 of the depreciation. So it's contrary to what the agreement says. Okay, so this is a review. We've done this now several times, where allocation to a partner who has no deficit restoration obligation, where part of it is okay and part of it gets reallocated under the PIP, and this is our special PIP rule, 1.704-1B2. So B2, B3, three little i's. And recognize none of this in year 1 and year 2 has anything to do with -2. Our minimum gain has been 0, hasn't gone up, hasn't gone down, so there's no impact to these rules. The rules we're learning now. That's why this is all review. In year 3, now this is the new stuff. And again, under the agreement, it would say allocate it to 198. These are non-recourse deductions. We tested under -2E. Let's go back to that test in the regs. We got several problems with -2E. We satisfy 1. 2, we're not going to be allocating anything else 1 and 99 other than depreciation on this building. And so we fail that. And this is similar to the problem we just did where, it's 99 to 1 non-recourse deduction. Made it a little bit easier. Maybe you got a fighting chance because it's not just non-recourse deductions that you're allocating this way. It's all cost recovery. But I think maybe going forward, it looks like that's a distinction without a difference, because under these facts, the only depreciation we're going to have going forward is non-recourse deductions. So that's a problem. And we also have this problem under 4. The fourth prong is that we've had items reallocated. Our partnership agreement has not been respected. In year 2, we had a significant reallocation of $76,000 of deductions that was supposed to go to L under the agreement that went to G. So we're outside the safe harbor here. One thing I'll just say on that, so we could make it easier for ourselves, at least the fourth prong, and this is what drafters of partial reviews will do, is they'll say something. Again, they'll say all depreciation 99-1. However, no partner shall be allocated an item of deduction or loss that would take the partner below the LDRO amount and would then reallocate it to G. So in a simple partnership agreement like this, we could say, we're going to allocate 99% of the depreciation to L. However, any allocation that would go to L, that would drive L below 0, shall be reallocated to G. And so we get the same result, but we wouldn't have busted. Our partnership agreement wouldn't have busted. In other words, it wouldn't have been disrespected. We would say to the IRS, no, we didn't get it reallocated. We followed our partnership agreement. So at least we get through prong 4. We still have a problem with prong 3. But that's one reason why drafters will sort of build in that their partnership agreements won't fail the alternate economic effect test. It'll be rigged, jerry-rigged, if you will, to not allow a partner to get an allocation that would take that partner below the LDRO amount. But in any event, we fail the consistency requirement too. So again, this will get reallocated in year 3, and 20/80, 50/50, who knows, but not 99/1. Okay, questions on that? All right, let's go to D. All right, so in D, we're back to the basic facts here. And again, same thing, year 1, year 2, year 1, 2, year 3, so that's all the same. And then we get to year 4, and in year 4, the partners are going to contribute cash to the partnership, and the partners are going to use the cash to pay down the debt. So in year 4, the debt's going to go down to 1.2 million. And G is going to kick in 80. So that increases his capital account by 80. L kicks in 160, increases his capital account by 160. I'm sorry, 320. And again, and the big thing is in year 4, we have no minimum gain. In year 4, we got 200 of depreciation. Takes our book value down to 1.2 million. If we sold the property amount of non-recourse debt at the end of year 4 for 1.2 million, we'd have no minimum gain. So our minimum gain went down. So that normally triggers a minimum gain chargeback. It normally requires us to charge back income to the partners. But there's an exception here. Let's look at dash 2F. Dash 2F. Again, if there's a net decrease in partial minimum gain, triggers an MGCV. A couple of exceptions. This is F3, right here. It says, however, a partnership is not subject to minimum gain charge requirements to the extent the partner contributes capital to the partnership that is used to repay the non-recourse liability, or is used to increase the basis of the property subject to non-recourse liability. So here we use the cash to pay down the non-recourse liability that reduced minimum gain. If we had contributed cash that was then used to improve the property, so instead of reducing the debt from 1.6 to 1.2, we increased the book value from 1.2 to 1.6. Same result. So this excuses the partners from the minimum gain chargeback provision. It makes sense because now they're bearing the burden of this again. They have now are bearing the burden of the property going down from whatever it is down to 1.2 million. They bear the economic burden. So no MGCB, that's -2F3. And we still have the 200,000 of depreciation in year 4 to allocate. And those are not non-recourse deductions. They're what tax lawyers will call recourse deductions, back to the regular rule, allocated 40, 160. Again, we test that for substantial economic effect. And the biggest thing is for L, is this takes L down to 0, but not below. Same thing for G. Again, G we don't care as much about because G has a deficit restoration obligation, L does not. So these allocations in year 4 have substantial economic effect. So the big thing in year 4 here is that no minimum gain chargeback provision, and they each get allocated 20, G40 and L160 of depreciation in year 4. Okay, questions on that? All right, in E, again, we're starting in E, and now in year 4, we convert some of this debt from non-recourse to recourse. We go to the lender and say, hey, we'd like to convert some of this debt, and agrees that the partnership will be liable for 600,000 of the debt. So in other words, we're going to turn this from a 1.6 million non-recourse to a 1 million recourse. And I'm sorry, 1 million non-recourse and 0.6 million recourse. Okay, why would the partnership do this? Probably not for tax reasons, but probably just to lower the interest rate. Now the bank has less risk. And so they can renegotiate the interest rate here. So one important thing here is that, again, in year 4, we have no minimum gain at the end of year 4. The book value is 1.2. The non-recourse debt, which is what we look at for calculating minimum gain, is 1.0. If we sold it for the amount of non-recourse debt and no more, we would have a loss, not a gain. And so there's no partnership minimum gain. So our minimum gain went down again. And normally when it goes down, triggers a minimum gain chargeback. So do we have to charge this back? That's the question. So let's look at -2 of F again. Now the exception for capital, nobody's contributing any cash. But now we're in -2F2. So the partner is not subject to the minimum gain chargeback requirements to the extent that the partner's share of the net decreases in partnership minimum gain. So G's minimum gain is going down by 40, and L's minimum gain is going down by 160. It's caused by a recharacterization of non-recourse debt as partially or wholly recourse debt. So that's partially recourse debt here. And the partner bears the economic risk of loss for the liability. So that's what's happening here with respect to G. We're turning some of the debt from non-recourse to recourse, and G, as a general partner, is going to bear the economic risk of loss for that debt. We're going to do more on economic risk of loss in a couple weeks. But we know from what we've already learned that economic risk of loss asks sort of the doomsday scenario, who pays? And it's pretty easy here. L's not going to pay. L has no LDRO and is a limited partner. G is going to end up suffering the entire burden of this. If things go really bad. So G is excused from the minimum gain chargeback. Normally G would be allocated 40 of minimum gain. I'm sorry, gain under the MGCB. But G is excused, and the rule is -2F2. We just talked about it. L is not excused. The minimum gain chargeback provision now applies to L. So we have to charge him back. And normally we charge him back with gain from the building. Normally the thing that triggers the gain chargeback is the disposition of the building. But we haven't disposed of the building. We could also trigger the chargeback if the partnership earns income that is then used to pay down the debt. Again, that's a more common scenario when the gain goes down. Or the lender could reduce the debt. That would be COD and cancellation of debt income. Here we have neither of those, but we still have to charge him back. And remember, this is where the problem goes in. What do we have? We have 150 of gross income the partnership realizes. That's the operating income. We have the 150 of other deductions. And then, of course, we have the 200 of depreciation each year. Every year thus far, we didn't have to worry about this. These just canceled out. But now for minimum gain chargeback, we have to, if we don't have enough net income, we can give him gross income. We can't give him more than we've got, so we just give him all. Remember, we got to charge him back 160. That's his share of the minimum gain reduction. So we got to get him 160. We only have 150 to give him. So he'll be charged back 150. The rest of the items here are supposed to go 2080. But we also know that L can't go below 0. I mean, at this point, L is at -10, which is okay because that's his share of the minimum gain that remains. We'll get to that next year. So we can't give L any of that. It's going to all end up going to G. So G is going to get 350 of deductions. I mean, technically, that's a substantial economic effect, an economic effect failure with the reallocation to G under PIP. We've done it a bunch of times and we don't have to do it now. That's going to be the result to G for year 4. Any questions on year 4? We're going to do year 5. Questions on year 4? We go to year 5. We still have no minimum gain because at the end of year 5, we're going to have another 200,000 of depreciation. Takes us down to 1.0 million, which is the amount of non-recourse debt. So we still have no minimum gain, but we still have to clean up L. The MGCB still applies. We're going to give him 10 of this. So 10 of that 150 is going to go to L. That gets him charged back fully for his share of the minimum gain reduction. And now we've got 140 of gross income left, 150 of deductions and 200 depreciation. This is -210. When we sum that together, we know L can't go negative, so it's going to all go to G. And so at the end of year 5, G's capital has -600. and L's is 0. And that makes sense. And if at year 5, we sold the property for its book value, 1.0 million, all 1.0 million would go to the lender. The lender would say, hey, there's 0.6 million of recourse liability that is owed to me. So partnership, you got to pay 600,000 in cash. Partnership doesn't have the cash. So then as a general partner, G's gonna have to kick that in. So G will end up having to write a check for $600,000, and that represents G's negative capital count. L just walks away from the whole fiasco. And that's why his capital count is 0. So this is the hardest problem by far, I think. And what it's designed to show, though, is again, we have the minimum gain chargeback, at least applying tentatively in year 4. G gets excused from it because of -2 F2. L is not excused, so L gets charged back. The chargeback takes 2 years to fully implement because we just don't have enough gross income. If we had 160 of gross income, we could deal with it all in year 4. And then whatever's left is deductions, net deductions, can't go to L, has to go to G. So we end up with that result. Okay, questions, comments on this? Now's a good time. Okay, in F, so generally, we typically generate non-recourse deductions, but because the property book value drops below the debt. That's typically what we see. Let me just clean this up. So again, what happened here is we have the building and we have the non-recourse debt. And the non-recourse debt stays at 1.6 million. We're not paying principal payments on the note. So the debt stays at 1.6 million. The building is drops below. So in year 1, it doesn't. In year 2, it doesn't. Once we get to year 3, what's happening is the building's basis is dropping faster than the debt. The debt's not dropping, the non-recourse debt. So that's typically how we get minimum gain. The building's basis drops via depreciation below the level of debt, which stays, the same or is amortizing more slowly than the depreciation. But we have another way we can create minimum gain, is the partnership can take out a second mortgage on the property against appreciation. So instead of the building's basis going down, we could have the non-recourse debt going up. And that's what happens here. So again, we say G and L, 80, 320. We have, again, years 1 and 2. We'll just do year 1 and 2 together. That's not interesting. We just combine years 1 and 2. Year 3, we had the 40 and 160 of non-recourse deductions. And again, our minimum gain table, we had 0 in year 1, 0 in year 2. In year 3, we have 200. What about year 4? Well, year 4 is pretty interesting because we have another 200 of depreciation. But the partnership borrows another $300,000 of cash. So the property, even though the book value is showing 1.2 million, this property is worth at least 1.9 million because the probably a lot more because the bank is booking up loan another 300,000 on a non-recourse basis. So now we have an increase in minimum gain for 2 reasons. It's gone up because the basis of the building's gone down by 200. The debt's gone up by 300. So our minimum gain is now 1.9 million plus 1.2 million. Now we have 700,000 of minimum gain. Minimum gain went up by 500,000. So normally, if our minimum gain goes up by 500,000, that indicates 500,000 of non-recourse deductions. Let's go back to the reg. Let's go back to dash 2C. Now, when we borrow money like that, we can do really two things with it. We can either keep it in the partnership and spend it on whatever the partnership wants to spend it on, salaries, maintenance. Well, there are really three things. One, we can improve the property. So you could throw it into the property, like, if it's a house, build an addition. That would increase the basis. And so that wouldn't cause an increase in minimum gain because the debt goes up, but the basis goes up. So that's one, that wouldn't cause any minimum gain increase. Two other options would cause a minimum gain increase. One is going to be if the partnership just spends it on other items, like salaries. Another is going to be the partnership can distribute it to the partners. And that's what's happening here. Let's go to dash 2C. The amount of non-recourse deduction from partnership tax equals the net increase in partnership minimum gain. But here, this is the key language for this purpose. Reduced by the aggregate distributions made during the year of proceeds of a non-recourse liability that are allocable to an increase in partial minimum gain. So that's what tells us our non-recourse deductions in year 4 is still only 200. It's our minimum gain increases 500, but we get to back out the distributions of the non-recourse debt proceeds. Recognize that if we had spent the money, if the partnership had spent the money, stayed in the partnership, spent it not on improving the property, let's say on salaries, that then the non-recourse deductions would be 500, and it would effectively be those salaries that we use the cash for would be non-recourse deductions. But since we distributed it, we don't have any non-recourse deductions for that portion. And so our non-recourse deductions in year 4 are still only the 200, and that's still 400 and 160. And then we have so these are the depreciation. And then we have the distribution of cash. It's going to go 60 and 240. So, well, I see we're at 10:20, so I'm going to stop here, and we'll do this problem again tomorrow. We'll do F again tomorrow, take another crack at it, finish it, and then move on to the next assignment. Like I said, don't get too discouraged. This is tough stuff. It gets better once you get more comfortable with the language. But the next stuff we're going to do is a lot more intuitive and less jargon filled. So things get better after today for all of us, including me. Okay, so we'll finish that up on Wednesday, and I'll see you then. Bye-bye.